Hi, my name is Leah Kratz, and I'm coming to you from Harrisonburg, Virginia, where I'm one of the co-authors of your financial accounting textbook. Today we begin Chapter 8, which is actually the first of two chapters that we will dedicate to the topic of inventory. Now, inventory are the items that a company has with the intention to resell for a profit. We want to discuss in this chapter what is being conveyed when an inventory balance is presented on the balance sheet. If you recall from Chapter 7, which was about accounts receivable, we learned that the balance listed on the balance sheet for accounts receivable is the net realizable value. So when a company lists they have $1 million in accounts receivable, what they're saying is that they expect to receive in cash $1 million. Similar to inventory, we want to take a closer look at what U.S. generally accepted accounting principle says should be reported with an inventory balance and what is being communicated in that inventory balance. Assets have a history of being recorded at historical cost. This has been a tradition in accounting for decades, and inventory is no different. Our first step in acquiring inventory is determining the cost of that inventory. So when we determine the cost of the inventory, we do what's called capitalize those costs, which is another way of saying we add it to an asset account. What we do with those costs is we accumulate them and we capitalize them or add them to the inventory account. Now, what costs get capitalized? We have a very simple but easy rule. And it's very important that we remember all costs that are normal and necessary to get those assets or inventory into position and condition to be resold are capitalized. Again, the point of inventory is to resell it at a profit. So all of those costs associated with getting that inventory or assets to us and into condition and position to be resold are capitalized. Examples of this may be the invoice price of the inventory, any taxes paid, or any transportation costs to get that inventory to us. Those are all examples of capitalized costs that would go into the inventory account. Another point we want to mention here is their coverage on discount terms. Oftentimes, when companies acquire merchandise, the seller will offer these discount terms to entice quick payment. Discount terms can be seen as follows. In this particular example, the way we read those discount terms is 210 net 45. And what's being communicated here is that the seller is offering a 2% discount if we make a payment within 10 days. Otherwise, any unpaid balance on that invoice is due in 45 days. Again, the seller is offering this discount to entice quick payment. So what happens if the discount terms are utilized? Well, the amount that's being sacrificed to acquire the inventory is ultimately reduced. Therefore, the inventory account is reduced by the amount of the discount taken. This discount is considered normal and necessary, and it will reduce the inventory balance. Now that we know that inventory is recorded at cost, the next question is to determine how a company maintains its inventory balances both in quantity and in cost. There are two methods currently used today. The first is a perpetual inventory system, and the other is a periodic inventory system. Perpetual inventory systems are often computer-based, and they have all of the information current and up to date about quantity and cost of inventory balances. So there's a lot of great information being conveyed in a perpetual inventory system. The downside is that oftentimes those systems are very expensive to maintain. On the other hand, a periodic inventory system makes no attempt at all to maintain quantities and costs of inventory throughout the course of the year. The positive side of that, though, is that they're practically free to operate. Under a perpetual inventory system, again, all inventory balances are maintained for quantity and cost. It's perpetually being updated with every purchase and every sale. Every time a company acquires more inventory, the costs that are normal and necessary to get that inventory into position and condition to be resold are capitalized, and that inventory account is increased. Also, every time inventory is sold, the inventory account is decreased, and those costs are moved to cost of goods sold. So at any given point in time, the company can determine what balances are in the inventory account, how many units they have on hand, and what the cost of those units are. That's a lot of great information available for managers and anyone interested in the inventory balances to use for decision-making purposes. On the other hand, under a periodic inventory system, no attempt is made to maintain inventory balances in quantity and costs. So as the company acquires inventory, those costs are recorded, but they're usually recorded in separate T accounts. For example, the inventory items might be put into, those costs might be put into a purchases account. The transportation spent to get that inventory to them might be put in a transportation in account, and so on and so forth. But the actual inventory account is not changed throughout the course of the year. If someone wanted to know the balance in the inventory and quantity or cost, it simply would not be available until the end of the calendar year. So the reason that this is important is because companies have to determine what information are they going to need and desire to make good decisions throughout the course of the year, and they'll need to determine which inventory system works best for them. Now, when a company is using a perpetual inventory system and they're getting ready to prepare their financial statements, all of the information that they need is already there. The company knows what its ending inventory balance is because the records have been maintained. They know the quantity and the costs that are on hand at the end of the current calendar year or fiscal year. Additionally, the company already knows the cost of the goods that have been sold because those have been transferred to the cost of goods sold account as they were sold. So when a company creates their financial statements under a perpetual inventory system, the company reports the ending inventory balance on the balance sheet. The sales are recorded on the income statement, and the cost of those sales are subtracted, which provide for the gross margin or the gross profit. So in a periodic system, when it's time to create the financial statements, the amounts needed to report inventory and cost of goods sold are simply not there. The records have not been maintained in a way that allows for the company to know exactly what the ending inventory balance is or the cost of the goods that have been sold. In order to find that information, the first thing that needs to happen is the company must take a physical inventory count. That means individuals must actually go out and count the items and the merchandise that are available. This provides the ending inventory, and this is going to be done very close to the end of the fiscal year. Once that ending inventory balance is determined, then the company can calculate what the cost of the goods sold is. And the way a company does that is it takes the beginning inventory account balance, which was known, it adds in all of those normal and necessary costs that were spent in the current period to get that inventory into condition and position to be resold, less the ending inventory, which was determined in that physical inventory count. That will give the cost of the goods sold for the period. Again, that's beginning inventory plus the purchases during the period less the ending inventory. That gives you the cost of the goods sold for inventory during the current period. Now, with the advent of computers and how common computers are, you might ask the question, well, does a company actually use a periodic inventory system now? And the answer is yes. Oftentimes you will see periodic inventory systems still in use in small companies. Again, perpetual inventory systems can be quite expensive, and the inventory balances for small companies might not be worth the cost that it would take to implement a perpetual inventory system. For example, if you ever go to get your hair done at a salon, the inventory that they have might be some hairsprays or gels or hair products. They might have a small display. It would be too much for a company like that to maintain a perpetual inventory system. A periodic system would do just fine in that situation. Additionally, maybe, for example, a restaurant where they have a fair amount of inventory, but it moves quickly, meaning they don't have a lot on hand at any one point in time. Again, a perpetual system might be more than what they need, and a periodic system would do just fine. So although in a lot of large companies you will often find a perpetual system, periodic systems are still used for small companies often. One question that we often ask is a physical inventory count needed in a perpetual inventory system? Now we know that in a periodic inventory system, a physical inventory count is required because there's no other way to know what the ending inventory balance is and how we would be able to compute cost of goods sold. But with a perpetual inventory system, the records are maintained. So is a physical inventory count necessary? The answer to that question is yes. Although we do have ending inventory balances and cost of goods sold balances, it's important for a company to know that the records in the perpetual inventory system are the same as what is actually on the shelf. Errors sometimes happen, and sometimes on the occasion even fraud can occur. So it's important for a company to maintain its inventory records and confirm that with an actual physical inventory count. One thing that impacts the physical inventory count is the idea of the FOB point, or the free on board point. These are the shipping terms that are negotiated when items are purchased or sold. The FOB point is the point at which title transfers. Legal title of the inventory will be transferring at that FOB point. So if you are the purchaser, the FOB point determines when you record the inventory and what point that inventory becomes yours. If you're the seller, the FOB point will determine at what point you record the sale. So we know that inventory is originally recorded at cost, and we know that companies want to sell their inventory at a price above cost because this produces a profit. But on the occasion, inventory values will fall below cost for some reason or another. In this case, the inventory balance being reported will be the lower of cost or the net realizable value because this is conservative. The net realizable value of the inventory is the amount expected to be received less the cost to sell it. When inventory falls below cost for whatever reason, U.S. generally accepted accounting principles requires us to report that at the lower of the cost or the net realizable value. Again, when you look at a balance sheet and you see an inventory balance, this is what's being communicated. So this is coverage that you will find in Chapter 8. Go ahead, read the text, read the material, learn all that you can. Learn all about inventory and what's being communicated on the financial statements when you see that balance reported.